Give a man a gun and he can rob a bank. Or give a man a bank and he can rob the world.
We are back now with breaking business news. Federal regulators have seized Silicon Valley Bank.
The 16th largest bank collapsed within hours.
It's the largest bank meltdown since the Great Recession more than a decade ago.
The California bank's collapse, the second largest in U.S. history, is now raising concerns about the broader economy.
This week, the government took decisive and forceful actions to stabilize and strengthen public confidence in our financial system.
Look, the bottom line is this. Americans can rest assured that our banking system is safe.
Silicon Valley Bank was closed by the California Department of Financial Protection and Innovation on Friday, March 10th. It's a bank that catered primarily to owners and executives of tech businesses and startups, some of which included Etsy, Roku, and Roblox. Within the span of a single day, more than $42 billion was withdrawn from the bank. Over 90% of the accounts held at the bank had over $250,000. Why is that number significant? Because the Federal Deposit Insurance Corporation, or the FDIC, insures up to that amount should the bank fail. That's the typical amount for nearly all banks, including the big ones. You'll more than likely find in the fine print at the bottom of your bank's homepage a statement showing that they're a member. The government came up with a plan to bail out the depositors, or the people who had money in the bank, money that if lost would lead to hundreds of companies getting into financial trouble, potentially going out of business, and thousands of people losing their jobs. Another potential effect of that money being lost would have been panic. People would begin to lose faith in their banks, especially regional ones, leading to more of them suffering a similar fate. And a couple more did. The government had to act fast to reassure the public that the banking system and our banks were safe, and that none of the actions would lead to a dime out of taxpayers' pockets. Stick with me, and I'll explain why this isn't quite the truth of it. Hey everyone, I wanted to take a moment to talk about what has unfolded over the past week, why it's playing out the way it is, and how it will affect you. Being that this is within the realm of the contents of my channel, I thought it would be a great opportunity to share some of what I've learned. This will be a Financication special report. To truly understand how this happened, we need to get an idea about how the banking system works, and we need to understand the factors and series of events that led to this very mess. Make no mistake, it's a big mess. I will attempt to explain each one in under a minute, then we'll come back to this question. Let's get a little backstory.
We are in the midst of a serious financial crisis, and the federal government is responding with decisive action.
News in-depth coverage now on the growing financial crisis.
I think this is the most significant financial crisis in the post-war period.
Leading up to the 2008 Great Financial Crisis, banks were reckless. They sold risky products to each other for trillions of dollars. It was fueled by greed, risk, and predatory lending that costed people their homes, jobs, and life savings.
The financial crash of 2008 was basically due to a wildly rigged system that was deregulated that caused the largest financial institutions in the United States and the world to engage in reckless, dangerous, and often illegal risk-taking that crashed the entire financial system and had to be bailed out, literally with trillions and trillions of dollars. One study put the dollar amount of the bailout at $29 trillion.
President telling reporters this morning that the Fed should lower rates and move to a strategy of quantitative easing.
Many people believe that could be highly inflationary, that it's a dangerous thing to try.
Well, this fear of inflation, I think, is way overstated. We've looked at it very, very carefully. We've analyzed it every which way.
After banks were bailed out in 2008 by taxpayer money, the US economy stalled. In order to jumpstart the economy again, the Federal Reserve, which I'll refer to now as the Fed, implemented something called QE, or quantitative easing. It was a tool the Fed created in an emergency situation to help stimulate the economy. This involved lowering the federal funds rate to near 0% and the purchasing of large amounts, we're talking trillions of dollars, of long-term assets like treasuries, toxic mortgage-backed securities from the banks, and agency bonds from Fannie Mae and Freddie Mac. It was the Fed's only way of injecting money into a stalled system. All that free money was supposed to encourage banks to lend to people and businesses, which would lead to economic growth. The government failed at putting rules into place called fiscal policy that would determine how the money would be used.
Please give us some fiscal policy, meaning give us some government action to direct this money to the right places.
One of the real problems with Washington policymaking is it's dominated by money, and it's dominated by the lawyers and lobbyists of those who have money, and really, let's face it, nobody has more money than the financial industry.
And there's also some assets purchased in there, which, not to wonk out too much, but is known as quantitative easing.
Similar to the impact of the Great Recession, the pandemic in 2020 stalled the entire economy. QE was implemented yet again, and extremely large stimulus packages kept getting approved to help shield the economy from the impacts of COVID-19. Approximately $4 trillion had already been injected into the system from 2008 to 2017. And by March of 2022, that number had reached nearly $21 trillion. It's very simple. Too much money in the system. The target rate of inflation for the Fed is 2% a year, meaning the prices of goods and services should rise by about 2% every year. Why 2%? Because it's widely viewed as an acceptable rate for stable economic growth. The problem is inflation has been on the rise at a much faster pace since March of 2021 due to the creation of money by the very same Fed. Wages have not kept up, not even close to the rate at which prices are increasing. It was spiraling out of control in 2021 and 2022, until it hit a peak of 9.1% in 2022. A common misconception that I'd like to clear up is that a lot of people tend to think prices are going down when the inflation rate falls. That's partly the fault of how the news reports it, but that's a wrong way of looking at it. Yes, some prices do come down, but the overall general trend is up. Imagine a rocket launching into the sky, and the rocket moving higher and higher represents rising prices. When the inflation rate falls, it just means that the rocket slows down just a little bit, but is still very much on the rise. Today's current inflation rate is 3 times the target rate of 2%, and things are just getting more and more expensive. Recent events have complicated the Fed's job. We'll get into that in just a bit. I will likely do a video in the future explaining how the fractional reserve banking system works. But the important thing we need to understand is banks are only required to keep a small fraction of the money you give them. They have the freedom of deciding where the rest of your money goes. It's an oversimplification, but gets a necessary piece in place. I did a great video on bonds. If you haven't seen it, go check it out. I won't go into too much detail, but the important factor we need to understand here is that when interest rates go up, the value of bonds go down. This brings us back to the question that started this. Let's look at the timeline. a bill was passed by the Trump administration that rolled back some of the stricter requirements created after 2008 to lower standards for banks that managed less than $250 billion. SVB's CEO lobbied for this very bill. QE lowered rates to near zero, making borrowing essentially free again. Tech companies saw a boom during the pandemic, and they parked billions of dollars with SVB. SVB, thinking the Fed would keep rates near zero, purchased billions in long-term bonds. Long-term investments are thought to be safe, and generally they are. But in the case of SVB, it turned out to be a bad management decision. Fed raised rates to combat inflation. Bond values fell in their worst year ever. In addition, SVB didn't have a chief risk officer for most of that year. After a bad year in the markets, tech companies began withdrawing more and more money to cover expenses. SVB had to sell some of its bonds to Goldman Sachs at a $2 billion loss in order to cover all the withdrawals. Customers caught wind of the bank's bad position and panicked, withdrawing $42 billion before it was shut down and seized by regulators. Everything I've explained up to this point played a pivotal role in what led to the collapse of this bank and poses great risk to our entire financial system.